Hello. Thanks for joining us today in our first session covering listed infrastructure. I'm John Tritel, Portfolio Strategist for Real Assets. I head our asset class research for the listed business at CBRE Investment Management. With me is Global Portfolio Manager Dan Foley, who is a lead member of our listed infrastructure strategy. We're here today to talk a little bit about our platform and one of the key questions that we get for listed infrastructure, which is how do we define the asset class? Dan, thanks for joining me. Do you want to give a few minutes on your background?
Yeah, sure. Thanks for having me, John. So, as John noted, I'm a portfolio manager with our listed infrastructure strategies. I've been with the firm for over 20 years and with the infrastructure strategy since inception back in 2012. Prior to that, working with our REIT team and assessing real estate securities. So, I've had a lot of coverage over time of, various elements of the infrastructure landscape globally. There is a large cross section of business models that we'll get into in some of the other videos that we'll explore, and it's quite an interesting space with a lot of pretty fascinating changes underway, driving the growth outlook going forward.
Fantastic. Thanks, Dan. So I'll start off with a brief overview of CBRE Investment Management. We are the investment arm of the CBRE Group. We run approximately 155 billion of strategies across public and private real assets. That includes both real estate and infrastructure. A key pillar of our platform is alignment with the private markets. If you look at listed real assets writ large, they often comprise a minority of the total investment opportunity set. And so just as an example of that, listed real estate is roughly a $3 trillion addressable market. The commercial real estate is about 40 trillion. We also find similarly that private infrastructure is one of the most important buyers of infrastructure assets globally, with about 1.5 trillion of assets under management. Our platform is well tenured. It's highly integrated. You can see the key participants of the platform of this slide on the slide from a leadership perspective. So Jeremy Ignagnos incepted our listed infrastructure strategy north of a decade ago. Stephen Dowd heads our private infrastructure group. Collectively, we have approximately 15 billion in assets under infrastructure management, with a very well diversified team spread across the globe, close to the underlying companies and investments under coverage. This is our team slide. You can see some of our direct connections with the private market research group at CBRE on the left-hand side. But Dan, maybe you could speak a little bit to the composition of the team and how we cover infrastructure securities just briefly.
Sure. So as you can see on this slide, we have a nine-member team. That team is spread across the globe. It's important infrastructure. These assets are global. Regulatory and policy dimensions, are important in how you think about and underwrite infrastructure securities. And we have a very well-established team. We've worked together for quite a long time. And as you noted, that team is really charged by Jeremy and Agnes, who's the CIO of listed infrastructure, and myself and Heinz Howard are co-PMs on the strategy.
Great, thank you, Dan. So turning to the research discussion, how do we define infrastructure? What is it? Dan, maybe I could just turn to you to start this off. Talk about the key assets in which we invest.
Sure. Yeah, I think infrastructure is an exciting space because we all recognize what these assets are because we interface with them every day. These are assets that are very much essential to our daily lives and economic growth, but they also have very durable cash flow streams that sort of derive from those high barrier to entry, element as well as their contracted and regulated cash flow streams. So when we think about what is infrastructure, first and largest are the utilities. These are electric utilities, gas utilities, water utilities providing clean drinking water. These are highly connected communications networks that span data centers and fiber, cell towers that really make, an increasingly important role, I think, in society undergoing another change today with AI. Midstream energy, these are the pipelines that carry the underlying commodities in a toll taker model, which is largely a North American opportunity set. And then transportation assets. And this is where we find a lot of investors think of first when they hear infrastructure. These are the airports, the toll roads, the rail networks that all collectively make up transportation infrastructure.
Great. Thanks, Dan. And when you think about it, I mean, what do these assets tend to provide investors? What are the key characteristics?
Yeah, so when investors come to infrastructure, they want these high barrier to entry assets, but they really come for the underlying attributes that these assets are putting off from an investment perspective. First and foremost, they offer some inflation linkage. So some investors are coming for a version of an inflation hedge in their portfolios. Um, but there's also an income element that comes from the cash flows and stability of these business models. So there's an attractive income component that's been very additive to total returns over time. But importantly, the third leg of the stool is there's a growth element to these assets that I think is sometimes underappreciated when you think about these being, sort of slow and steady assets. They're actually pretty fast growers. We've seen that growth accelerate over time, and that's really coming from a growing need for infrastructure assets to be modernized and hardened to fit, current, market needs. And so I think it's the combination of all three of those things that really is the sweet spot for infrastructure to provide, that mix of income growth and inflation.
Gotcha. And I think at the end of the day, what's driven this performance for investors are the cash flows of the companies. And so maybe we could just talk a little bit about how the cash flows have performed over time.
Yeah, so that the stability that I mentioned is really shown here. So what you're looking at in this slide are three things. One, the bright green line is just US CPI, so just a measure of inflation, and you can see that that's slowly crept up over time. And the line at the top is the growth in EBITDA of the listed infrastructure universe, over a very long duration. So this is going back into the early 2000s. Um, the line in the middle is growth in EBITDA of broad equities. And so what stands out is through different market cycles, different market shocks, financial market shocks, varying, um, you know, issues we've seen over time that have driven periods of outsized volatility. Infrastructure just continues to kind of march up and to the right from an earnings perspective. And again, that really gets to the fact that despite those macro shocks, the world still needs infrastructure assets every single day. The demand profile remains consistent, whereas the earnings that you see here for global equities is much more subject to underlying volatility, and demand side disruption that you might see during these kind of macro periods.
Great. Yeah, no, I appreciate that. I think this is very much a key slide, and we'll return later in the conversation in terms of some of the performance that infrastructure has generated as a result of these cash flows. So we've talked a little bit about what infrastructure is, Dan. Maybe we could talk a little bit about what it is not, in our view.
Yeah, well, this is a great conversation because we get it a lot. I think there's not one, commonly globally held view of what is infrastructure. And there are lots of things that live around, the edges of infrastructure, users of infrastructure assets, companies that own essential assets, but maybe, use them in a more competitive, volatile cash flow stream that doesn't really fit that defensive, inflation protected, durable cash flow stream we talked about. I think telecom's a great example of the latter. Telecom companies, are large companies. They've owned communications assets for a very long time. For example, in the U.S., Verizon, AT&T, these companies own a lot of fiber. Um, but the business model, is very, very competitive. They are a consumer facing business model. They don't have that durable, resilient, inflation protected cash flow stream that we're looking for and that you can find in, say, a tower owner who is more of just, facilitating those networks and riding on more of a toll taker model to those telecom customers. And we see other areas of adjacent infrastructure businesses, things like airlines, who are using the airports. They're a customer of the airports, but certainly much more competitive business market, competitive business environment for those kinds of businesses. So what's in are companies that fit that resiliency test, durability of cash flows, and essentiality of the assets. What's out are companies that are adjacent and don't have the same competitive moat that infrastructure companies have.
Gotcha. Thank you. And so we've talked a little bit about what's out. But obviously change is a constant, right? The world evolves. And so how has infrastructure evolved over time for us?
Yeah, I think this is another very good point to make because infrastructure, despite infrastructure having been, an element of our lives forever, um, changes happen across society. 20 years ago, we didn't have, iPhones yet. And now, a significant percentage of the population, can't live without it. And that requires a lot of communications infrastructure to make it so you can stream videos on that iPhone. We're undergoing another sea change with AI today in that ecosystem, but you need to think about what is the opportunity set of that universe and how does it change and how will altering global flows of energy give rise to different investment opportunities for investors that come to infrastructure. So that's a way of saying, the core four, if you will, of what sectors make up infrastructure remain consistent over time, but the way society interfaces with them changes, and that can give rise to winners and losers. And you need to have, I think a view of the investment universe that understands where those changes are happening and can actively manage a portfolio to take advantage of those opportunities.
Great. Thanks, Dan. I appreciate that. And so just maybe exploring that universe a little further. Could you go into a little bit of depth in terms of how it's composed, the liquidity, how it may not or may compare to some of the major infrastructure benchmarks that are listed and that are out there?
Sure. So I think first and foremost, our investment universe, just to highlight the size, it's over 300 companies, $5.5 trillion in equity market value. And just to hit your question right off the bat, there are some definitions of infrastructure that would say it's more like 100 or less companies and significantly smaller in size. And the way you would get there is by saying things like communications infrastructure shouldn't be included. And so it's just a very differentiated view of how some investors view infrastructure. We think it's important that you know investors that come into the infrastructure space have the full complement of investment opportunities in front of them, and we have a very much an alignment with how the private market views this universe. Um, to just hit quickly on what is that universe and how does it look, on the left here you see the geographic makeup. More than 50% of listed infrastructure by equity market cap is in the U.S., another 9% in Canada. So you get just over 60% in North America, a few more percent if you add Latin America. You get just over 20% of the investment universe in Europe, and the balance is then spread across developed and emerging Asia Pacific. But by sector, you know, close to 50% is the utility space. That's electric, gas, water, other utilities that own contracted power, things like renewable assets that fall into what we call integrated electric here on the chart. Um, Followed by transportation. So transportation is a mix of, as we noted, rail, airports, toll roads, ports, and midstream, which is largely North American. That's 17%. And the balance, just under 10% of the investment universe is in communications infrastructure, which for reasons we just noted has been growing, as that's been one of the largest changes, I think, over the past 20 years in the infrastructure universe.
Great. Thanks very much, Dan. So following the discussion of the universe, I wanted to talk a little bit about what that has done over the course of time for investors. And so what you can see here on slide 14 are, I think, are some very key characteristics. The first is total returns. Listed infrastructure has performed in line with broad equities over the last 25 years. It's actually underperformed broad equities over the trailing 5 years, which we think actually represents an opportunity for catch up, an opportunity for outperformance. But the long term track record is quite clear here. Infrastructure, by virtue of the regulated and contracted cash flows, by virtue of the different types of sectors that can access different degrees of economic cyclicality or protect against different forms of economic downside, has a very attractive upside capture and downside capture spread. And so when broad equities are doing well, infrastructure has generally kept up. When broad equities have done poorly, infrastructure has saved investors money. And I think that's very much what we want from the asset class, is that sort of resilient performance over the course of time. It's obviously done so with lower volatility. That is something that you should expect from cash flows that are regulated and that are contracted. And finally, over half of total return comes from income. The income is quite sizable. It's growing. These companies are incredibly well capitalized, good leverage overall, solid balance sheets. And so the income return for investors has been important. Other key reasons to invest in infrastructure include inflation capture. So several of the companies and sectors that we've talked about, they have regulated or contracted mechanisms to recapture inflation. And so what you've generally seen is that infrastructure has outperformed broad equities by approximately 500 basis points over periods of time in which inflation has remained above average. We see infrastructure as both a complement to broad equities and as a complement to private markets, where in listed markets we generally see discounted valuations for large cap infrastructure assets. We see very compelling regulated sector exposures, and we see very strong blending benefits on a risk adjusted Sharpe ratio basis when you blend public and private infrastructure together. So, a lot of reasons to invest in the asset class. Future sessions will include how we value infrastructure companies, other key considerations and questions investors have posed to us about infrastructure. But with that, we'll conclude our call today. We very much appreciate your time and your interest in the asset class. If you have any further questions, please reach out to me or please reach out to CBRE IM representative. And thanks very much. Take care. Bye.